Hi, welcome to this video tutorial on position sizing and risk management. I'm Adam Khoo, and I can tell you that as a professional trader, understanding how to size your positions and how to manage your risk is one of the most important topics that you need to understand to achieve consistent profits as a professional trader. So once you're ready, let's begin this lesson. So what is position sizing all about? Well, it's the part of your trading system that tells you how many shares that you buy for each trade or how many shares you short for each trade. What is the size of the position you're taking? In fact, if you look at what makes a successful trader, 60% comes from psychology, your mindset in following the rules and in managing your emotions. 30% of your success comes from your position sizing, risk management, if you will. And only 10% comes from the actual strategy that you use, which means your entry signals or your exit signals. So you can see how important position sizing really is. I know many people who learn all about technical analysis and fundamental analysis, but they can't make money consistently because they're not sizing their positions the right way. And so that's how important this video really is. Now, what does position sizing help you to do? It helps you to determine, number one, how many shares should you go long or go short in on a trade. Number two, what your risk per trade is and the overall risk to your portfolio at any point of time. And finally, what are the expected returns you can expect from your trading, so you know roughly the income you can earn per year or per month. So here are the steps in position sizing. Step number one is to know what is your capital that you have right now. In your brokerage account, they call it your net liquidation. Your net liquidation basically means the value of your account, which includes the number of shares you have, the market value of your shares, plus unused cash. So let's take, for example, that in your account right now, you've got $10,000 in net liquidation, cash plus existing shares if you do. Step two is you must determine your risk per trade. What does this mean? Risk refers to the maximum loss that you can take per trade. This is the maximum that you can lose if your stop loss is hit. Because as a trader, we always place our stop loss at a certain level. Now, this loss should never be more than 1% to a maximum of 3% of your existing net liquidation. In other words, you never risk more than 1% to a maximum of 3% of your capital on any single one trade. If you take nothing from me, take this one idea. It will make you a lot of money and save you when times go tough, when times get tough, right? So for example, let's imagine that the risk per trade that you're taking is 1% of capital. Now, I have to say this. Once you decide on your risk per trade, you have to be consistent about it for every trade until you decide to increase it to 2%, and then you have to consistently use 2%. You can't keep changing from 1% to 2% to 2% to 3% on a trade-by-trade basis. It doesn't work. You got to be consistent. All right? Great. Step three. So you know your net liquidation. You know your risk per trade. In this case, it's 1%. So to calculate our position size or the number of shares to buy, we use this formula. Okay? We take our risk per trade. So in this case, it is 1%, which we have predetermined. All right, and we multiply it by our capital or our net liquidation. So in this case, it is $10,000. Okay, and we divide this by the risk per share that we are taking. So let me explain this with an illustration. Let's imagine you've got a trade right now and you want to go long on Bank of America, okay? And your entry price is $8.60. And you decide to put your stop loss at $7.90, okay? Now, when you watch the videos on the specific strategies, whether the strategies are bounce strategy or piranha strategy, slingshot strategy, or breakout strategy, I'll teach you exactly where to put the stop loss. So that is coming in the future lessons. But for now, let's assume that your stop loss is at $7.90. All right? And you have a profit target of $10. So how do we calculate the number of shares to buy? Let's go step by step. All right. So we buy at $8.60. That's our entry price. We place our stop loss at $7.90. Okay? So what is our risk per share? Our risk per share is 70 cents. How do you get that? $8.60 minus $7.90. Which means if we are wrong about this trade, it hits our stop loss, we lose 70 cents per share. That's our risk per share. Got it? Great. Now, we always have to place our target profit at double our risk. So if we are risking 70 cents per share, our profit target should be at least double that, which is in this case $1.40 above our entry price, and hence we get $10. All right? Great. So, how many shares do we buy? So remember the formula, okay? The formula is risk per trade, which is 1%, multiplied by our existing capital or net liquidation, which is $10,000. Okay? So 1% multiplied by $10,000 is $100. So what does this mean? That means that the maximum you can lose for the trade is $100. That's the most you can lose. Okay? Now, the risk per share is 70 cents. For every share you buy, you're risking 70 cents. So how many shares can you buy? Well, you take $100, which is the total risk, divide by 70 cents, which is the risk per share. So that gives you 143. There you go. So with this, you know that you can buy 143 shares of Bank of America. Okay? So you're paying $8.60 multiplied by 143, and that gives you a position size of $1,229.80. Okay? So this means that out of $10,000 in capital, you're using $1,000 to buy shares in Bank of America. That's your position size. But notice that 1,200 is not your risk. Your risk is $100 because that's where your stop loss is, right? So understand that your position size is not your risk, all right? Now, if you buy the shares outright, you have to allocate $1,200 to buy the shares, which means that you've got about $8,800 left to buy other shares, okay? If you use derivatives like CFDs, CFDs are known as contract for differences. They are not available for US citizens, but if you're a non-US citizen, you can use CFDs, which means that you can buy the shares with only a 10% deposit. So by taking on this position of $1,229, I don't actually have to use $1,200 from my capital. I just have to use 10%, which is $129. Which means out of $10,000, I only need to allocate $129 to take on this position, which has a risk of $100. So this gives me a lot more cash to buy more positions in the future. Okay? So, you've bought your first position, which is Bank of America. You've got a 1% risk going right now on your capital. Can you take on another trade at the same time concurrently? Yes, you could. Okay. So let's imagine right now we've got another trade that we want to take, and this time we want to go short on JCPenney because it's on a downtrend, for example. Okay. So we decide to go short at $16.50. That's our entry price. And we decide to put a stop loss at $18.60. Maybe it's above the resistance level, for example. Again, in the lessons to come, I'll teach you exactly where to put the stop loss for specific strategies. Okay? And we've got a profit target to exit at $12.30. So how many shares can I now short for this trade? Same formula. Let's go and take a look. Okay. So in this case, I sell JCPenney at $16.50. That's my entry price. That's where I do my selling short. Okay. And I put my stop loss order at $18.60, which means if it goes up, I close my trade, I get out with a small loss. Okay. So this gives me a risk per share of $2.10. Why? Because if it hits my stop loss, I lose $18.60 minus $16.50, $2.10. That's my risk I'm taking per share I'm buying. So if I'm risking $2.10, I have to make at least double that to make it worth my while, right? So my profit target has to be $4.20 below my entry price. So that gives me a profit target of $12.30. That's how I set up the trade. Okay, so how many shares can I short? Once again, I use the same formula. What's the formula again? You take your risk per share, which is 1%, and multiply by your net liquidation, your capital. Now, here's where it gets important. Let's imagine you bought Bank of America initially, right? And Bank of America did not go up in price, it did not go down in price. It's the same price, okay? So in that case, what is the value of your account? It's still 10,000, okay? Although out of the 10,000, you've already taken up some capital, which is about 1,002 to buy Bank of America shares. But you still have $8,000 in cash, right? But the total value of the account is still 10,000. So you risk 1% of that same 10,000. Because the risk is cumulative, which means that now if you take on 2 positions, your total risk is 2% of your capital. Okay? But if you had bought Bank of America, for example, and Bank of America was a losing trade, right? It went down and hit your stop loss and you lost $100. Remember that as your risk? So now from $10,000, what's your net liquidation? 10,000 minus 100 is 9,900, right? So if that was the case and you now take on a new trade, you would risk 1% of 9,900 because that is your current net liquidation. But if you bought Bank of America and Bank of America went up as you anticipated and it hit the profit target, you made a profit, right? So now your capital has grown from 10,000 to 10,200. Okay, you've got bigger capital now, right? So if you take on a new trade, you now risk 1% of 10,200. Okay, so in other words, as your capital grows, you risk that same 1% of a bigger capital amount. As your capital shrinks because of losing trades, you risk 1% of that smaller capital. So by doing this, it ensures that when you're winning, your capital grows at a compounded rate. If you happen to be losing, okay, you tend to reduce the risk substantially in a compounded fashion. All right, so let's go back to this example over here. Okay, so 1% again of 10,000 is $100. So again, we are risking $100 on this second trade, but each share that we are entering, we are risking $2.10. So your total risk of $100 divided by $2.10 gives you 48 shares. Short. Minus means short. So that means that we're going to short 48 shares of JCPenney. Now, each share is $16.50, right? and we multiply it by 48 shares, so our total position we are short is $792. Okay, so notice that for Bank of America, we bought, our position rather was 1,200. For JCPenney, our position is $792. So it's a different position size, but the risk is always the same. Always remember that. For every trade, the risk must be the same, although the position size is different. Okay? So this is the position sizing calculator that I'll make available for download on my website. And let me just show you how it works. So what you do is you key in the boxes in white over here. 1, 2, 3, 4, 5. And it will calculate the number of shares that you go long or you go short based on your trade. So let's take a look at those recent examples. The first one was Bank of America. So if you recall, our capital is $10,000. So just key that in. And our risk per trade is 1%. Again, you could always adjust it to 2% if you want to take more risk. All right, so in this case, we're using 1%. And what's our entry price? For Bank of America, it was $860, if you recall that. Our stop loss price was $790. And our target price was $10. So the moment you key in these figures, immediately it will show you your risk to return ratio. In this case, you're risking 1 to make 2. So you're looking at 2, which is your return. Your risk per share is 70 cents. Your profit per share is 140. So again, you're risking 1 to make 2, which is essential in any kind of trade you make. And it shows you immediately the number of shares that you need to buy in order to achieve this, which is 143 shares to go along. In the second example, I was going short on JCPenney. So for going short, my entry price was $16.50, which I'm going short. My stop loss price is higher than my entry price, right? Because if it goes up, I'm losing money, I got to exit the trade. So that's $18.60. And my target price to exit with a profit, $12.30. Again, I've got my 1 to 2 risk to return ratio. I'm risking 210 to make 420. And this time you can see that the number of shares is negative 47. So when you see a negative, that indicates a short position. You're selling 47 shares of JCPenney to take on this position. So how many positions should you take concurrently when you're trading? Well, it depends on your risk threshold. And here's my suggestion. So for example, when you take on your first long position on Bank of America, you are risking 1%, right? And that risk is also known as 1R. R is a unit of risk you're taking. So whenever I have a losing trade, I never think that I lost 1%. I think that I lost 1R. I'll explain that more in greater detail. So for, again, Bank of America, your position size is 1,200 with a 1% risk and a potential of achieving a 2% return if it hits your profit target. So you're risking 1R to make, that's right, 2R, okay, or more, but at least 2R. When you take on your second position, which was a short position, again, you're shorting JCPenney, it's a different position size, but your risk is the same at 1%. And again, your potential return should be at least 2%. So to keep it simple, I'm assuming that all your profit targets are 2R, or 2 times your risk. Okay? Now, say you take on another position, which is McDonald's, right? So now you risk another 1%. You take on Apple, that's another 1%. So notice that usually if you take on 4 positions, okay, you usually run out of cash. All right, so in this case, you can see that each position would take up about $1,000 to $2,000 in cash. So if you take up 4 to 5 positions, you have used up your $10,000. In other words, you can't buy anymore. So the most risk you can take is probably about 4 to 5% of cumulative risk at any point of time. Okay. Now, Let's take a look at this example. So the total risk in this case is 4%. In other words, if all 4 trades fail, okay, you are down 4% on your capital. Okay. What if all 4 trades are winning trades? Excuse me. If all 4 trades are winning trades, then you would make 8% gain in your capital, right? So, but what if you get a 50% win rate, which means that out of 4, 2 are winners and 2 are losers. So let's imagine the first 2 are losers and you're down 2%. And the next 2 are winners and you are up 4%. So on a net basis, what's your return? Your return is 4 minus 2. You're up 2%, as you can see. So the beauty of sizing your positions in this way is that even if you are right half the time, or in fact even less than half the time, you are still profitable. Why? Because your average win is always double your average loss. And that's the most important key to successful trading. Now, if you use derivatives like options, for example, or CFDs, I like to use CFDs, or contract for differences. You can do a search online and read more about it. I'll also probably do a video tutorial on it in the days to come. With CFDs, I've mentioned before that you don't actually have to use up your cash to buy these positions. You only have to use 10% of the position in cash, which means that if I buy Bank of America, I don't need $1,229. I only need 10%, which is, what's 10% of that? 10% of 1,000 is, that's right, $100. Okay? So in other words, I only need $122 here. Okay, and 10% of that is like 79 bucks. 10% of that is $130. 10% of that is $160. So if I use CFDs, contract for differences, you find that after taking 4 positions, I'm only using 1, 2, 3, 4, about less than $600 in cash out of the 10,000 I have, which means I still have $9,400 in cash to take even more positions. Okay, but that doesn't mean you should go on a crazy buying spree. Yeah, my suggestion is that at any point of time, you should not have more than 10% of total cumulative risk on your portfolio. That means if you risk 1% per trade, you should have no more than 10% of concurrent trades. So in the event that all of them are losers because the market crashes and you're all long, you only lose 10% of your capital. Okay? Right. Okay, great. So got that? Good. The other thing to ensure is that when you have got a portfolio of trades that are concurrent, ensure that they are not correlated. So in other words, if you have got 10 positions, ensure that not all 10 of them are banks, for example, like Bank of America, Citigroup, JP Morgan, Goldman Sachs, Morgan Stanley. That's stupid, because if the financial sector goes down, you get stopped out for all your trades. So you want that to be between different sectors and different industries. No more than 2 stocks in the same sector or industry. Okay? So why is it important for us to limit our risk to 10%? Because if in the event that you get all of them as losing trades, your capital is down 10%. Now to recover from that, you just need to have an 11% gain on your balance to break even. It's pretty easy, okay? But if your capital goes down by, say, 20% or 30% in this case, to recover to break even, your balance has to gain 42.85%. If you lose 50% of your capital to get back to break even, your balance has to get 100% return. So that means that the larger the fall in capital, or what we call the drawdown, the more difficult it is to make it back. So we always want to limit our risk of our portfolio to a maximum of 10%. So at the very most, if you're really high risk taker, 20%, but not more than that. So what kind of returns can you expect to achieve as a trader? Well, let's take a look at this important formula. If you have studied statistics or probability in school, you know this, that when you play any kind of game of chance, and trading is a game of chance, right? There's a formula that we use known as the expectancy formula. It calculates the expected profit per trade based on these parameters. Okay? Your percentage win multiplied by your average win minus your percentage loss multiplied by your average loss. Okay? So, let's say you follow the rules, right? So you buy on the uptrend, you sell on the downtrend, you watch out for support and resistance, blah, blah, blah. Can you be right all the time? No, you can't, right? In fact, I can tell you realistically, as a short-term swing trader, your win rate would be on average about 55%. And that's being realistic as a swing trader. In other words, out of 10 trades, you can expect to win about 5.5 of them on average and lose 4.5 of them on average. Okay? Of course, there'll be good months when your win rate could go up to 60% to even 70%, but that's not sustainable. On the long term, I would say a 55 to 60% win rate is pretty conservative. Okay? So in that case, 55% of the time we'll be having a win, and 45% of the time we'll be having a loss. Now, what's our average win, average loss? Assuming you risk 1% per trade, that means your average loss is $100. If you do that, your average win will be 2% per trade or $200. Why? Because you always maintain the 1 to 2 risk to return ratio, if you remember that, right? So using the formula, what do you get? 55% multiplied by $200 minus 45% multiplied by $100, which is the average loss, average win. If you do the math, that will give you an expected profit of $65 per trade. So what does this mean? This means that in a large sample of trades, you have winners, you have losers. When you win 200, you lose 100. But if you average it out, each trade that you make would on average give you a $65 profit. This is what we call a trading system with a positive expectancy, which means that if you keep trading the system in the long run, you make an average of $65 per trade. But you never know when the wins and the losses will come, of course, right? So in other words, on average, if you do 20 trades a month and you multiply that by $65, on average, you're making $1,300 in profit a month, okay? And if you have $10,000 in capital, 1,003 out of 10,000 would amount to a 13% return in capital a month, which if you compound 13% a month in a year, it's phenomenal. And this is based on a 55% win rate, okay? At a 1 to 2 risk to return ratio, okay? Now, one of the most important things in trading is to maintain your emotions. Okay, and the way to do that is to not think in terms of dollars. Because when you think in terms of dollars, you get emotional. Like, wow, I just won $500. I just lost $200. I just, won a new TV. I just lost a Big Mac. Okay, whatever it is, right? So successful traders always think in terms of multiples of risk, or R's. Okay, we think in terms of R's. So when we lose 1 R. We don't lose $100 or $1,000. Okay. Now, what is 1 R? 1 R is 1% or up to 3% of your capital, which is up to you to determine. Okay? So again, a losing trade results in a minus 1 R. A winning trade results in a plus 2 R or more. Okay? So if you use R and you put it into the expectancy formula, what do you get? You get this, which is similarly a 55% win rate and a 45% losing rate. So when we win 2R. When we lose 1R. So if you do some simple algebra, that's 1.1 minus 0.45. That's a 0.65 R profit per trade. Okay. So if you do 20 trades a month on average, and multiply by 0.65, you're getting about 13 hours a month. Okay, so what does 13 hours mean? Well, 13 hours simply means that if you were risking 1% of your capital, you'd be getting a 13% return. Okay, if you're risking 3% of your capital on every trade, 3% times 1 hour, which is 13. So 13 times 3 is 39% return. Okay, so you may be saying to yourself, hey, in that case, why don't I risk 3%? Because with 3%, I get a 39% return a month. Well, theoretically, it sounds really good. But you got to understand that emotionally, it creates more volatility in your portfolio. Why? Because you don't win all the time, right? So even if you have a win rate of 50% and you are trading, you don't always get win, lose, win, lose, win, lose. It doesn't happen that way. Many times in trading, you can have many wins in a row, like win, 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 or many losses in a row. In fact, I can tell you that it is very common to have at times 5 to 6 losses in a row, even with a win rate of 50, 60, 70%. So imagine if you have got 6 losses in a row, okay, and you're risking 1%, what happens, right? You get a drawdown of minus 6%, which means your capital falls by 6%, which to most people, no big deal, they keep trading, right? But if you are risking 3% of your capital and you get 6 losses in a row, and you're risking 3% with each trade, your drawdown is 18%. Okay? And to most people, if they're losing 80%, 18% of their capital, they tend to get really emotional. Oh my God, what's happening? And that screws up their psychology and causes them to fear taking the next trade. Now, of course, if you're someone who has got very high risk tolerance and say, you know, that doesn't bother me, I can do that, fine, go ahead, no problem. Okay, but my suggestion is keep it to 3% or less. In fact, I suggest when you start out with 1%. I've got some trader friends who are crazy. They risk 10% per trade. And yeah, some of them make a lot of money. I've got one guy who started with $10,000. He built it up to now about $8 million. All right, sounds great, right? But if you risk 10% a trade and you get 6 losses in a row, that's a 60% drawdown. And my friend can take it emotionally because I think he doesn't have a pulse. He's got big balls and I don't have big balls, right? So if you like to do that, you can, but I don't suggest that. I suggest sticking to 1 to 3%, make it more realistic, and you may not make millions overnight, but you make a pretty good income and return on your portfolio. So this concludes this lesson on position sizing. If you like this video, please click like. If you'd like to subscribe for more videos, click the subscribe button. And if you want to find out more about our live training courses or online courses, you can go to wealthacademyglobal.com or piranhaprofits.com. And piranhaprofits.com will be launching sometime in July 2017. Apologize for the delay because of some technical issues, but we want to get it out as soon as possible. So with that, take care, happy trading. Adam Khoo signing off.